What I'm not going to be doing today is giving any taxation advice or advice on companies. I'm going to look at this purely from a lender's point of view and talk to you about what is attractive to mortgage lenders. So who am I? My name is Harvey Bowes. I'm Managing Director of Harvey Bowes, expert mortgage and finance brokers who specialise in funding properties for property investors. We're fully and directly regulated by the FCA, and we search mortgages from the entire marketplace to find what's best for you as the client. But let's talk about limited companies. So one of the first things I'm going to talk to you about is just company formation and company structure. So lots of accountants tell you to have kind of a limited company over the top. This would be your holding company, and then you might have, your trading company underneath. So let's say you do some rent-to-rent, letting agency, could be a plumber, or you could have any type of business you want. And let's say that's your trading company. Your trading company is there, and then your SPV for property, your special purpose vehicle for property investment, is here as a separate business. And then you have a holding company in between. Lots of accountants, they like to encourage people to have this structure. Now, for taxation reasons, there may be some reasons why, and I'm not going into the taxation side of it. I'm just going to talk to you about the lending perspective. If you're doing simple buy-to-lets, lenders that will lend to a limited company will not lend where you have this structure. They want to lend to an SPV that is on its own, that is not part of a group of companies. Now, if you're doing HMOs, multi-unit blocks, that type of thing, then plenty of lenders that work in that field will accept this structure, but not lenders who've got the best rates out there for a limited company for simple buy-to-let, regular sort of family-let AST type stuff, the single-let stuff. Okay, so when we're talking about limited companies, something else that we need to remember, we've talked about the structure and whether it's part of other limited companies, is the way that limited company is organised with its directors. So one of the things to mention is you've got different types of shareholders. The main areas are A, shareholders, and B, shareholders. Okay, so if you're a B shareholder, it means you've got no voting rights in that company. That's one of the things about a B shareholder. So some people choose to put maybe their children in as B shareholders, or perhaps you've got an investor that sat in the background. They provided some money for this limited company, which is now buying properties, a property SPV. They have no voting right. They've got no say in how the company's run, but they put some money in. You might want to give them B shares. Now, if you do this, again, there are limited company lenders out there, mortgage lenders, that will only allow A shareholders. So if you've got B shareholders, you still get a good range of lenders, but slightly less lenders. This is more important if you're doing standard single-let properties, less important if you're doing HMOs and multi-unit blocks. Again, one of the things to note is that you will have a problem with most lenders, regardless of what type of property you're buying, if the B shareholders own more than 20% of the shares in the company. Now, for many businesses as well, whether they're A or B shareholders, lenders will allow you to have 20% shareholders. There could be a couple of those in the company, just own 20%, and they don't need to go on the mortgage application. So if they've got any credit issues in the background, or if they don't want to be financially linked to the other directors, if these people, whether they're A or B shareholders, have got 20% or less, for many lenders, they won't have to go on the application. So that has some relevance, and we see that quite often with company structures for property investors. When you're looking at doing a structure, quite often we see joint ventures where two property investors are coming together to do a property deal. And those two investors, they have their own companies. They've already got SPVs set up for property. So what quite often happens is you might have the structure where you've got the company, limited company here. That limited company owns this new property that you're investing in, and in that company, 50% of the shares are owned by joint venture partner A, his limited company, and 50% of the shares in that company is owned by joint venture B and his limited company. So quite often you've got this structure, and accountants encourage you to create a new firm here, new business, a new limited company. Now that means there's an extra set of accounts, etc. One of the things that's quite easy, if you like, with that is the potential to sell that property on in the future. So I understand that there's a reason why you might do that for the future. There are several arguments and discussions around that we would have with you as your brokers. But one of the things I see is that people automatically think they need to do this, whereas you don't actually. So what you could do is you've just got the property investment, the house you've got, the HMO, whatever it is. So you've got that. And you can still have joint venture partner A and joint venture partner B. They don't need to set up this separate limited company. What they simply do is they own, this company owns 50% of the property and this one does as well, instead of doing it on a joint tenancy basis. So that's another way of arranging it. It means you don't have this extra limited company and the extra set of accounts for that as well. That again is much better and we see it more with people investing in more sophisticated property investments, your HMOs, your multi-unit blocks, etc. If you have a trading company, don't forget that most lenders don't like a trading company, so a company that does something else. We talked earlier about a plumbing company or a stationery company, whatever that might be, that owns property within that company. For investment purposes, they like to see a separate SPV, but if it is a trading company, there is a handful of lenders that will accept that or consider that. So the last piece of advice for this quick video on limited companies is housekeeping, and housekeeping on charges. And this is a really, really important tip if you want your deals to go through quickly. It's something that most even experienced property investors miss. And as brokers, we're looking after this for you and reminding you of this on a regular basis. So if you have a limited company and you buy your first property, and then in that same limited company, you go to buy the second property. When you buy the second property, the lender on the first property has probably got a debenture or a floating charge over the business as well as over the specific property. And you have to get from that lender a letter of decrystallization. And that means that you can then open the new loan facility on the new property for the day of completion. And quite often we get solicitors that forget about this, and then right at the last minute they discover the debenture. They've not searched for it before, which they should have done, and so it causes that last minute delay on completion. You've got to go back to that old lender, get the letter of decrystallization, and then move on. So much better to organise that in advance. Don't forget it and leave it to the last minute. But here's another part of that same tip, and a really important one. If you buy a property on a bridging loan, when you move on from that bridging loan, you want to make sure that they have taken their charge not just off the property, but also off the company's house. They don't do it automatically. You've got to ask them to do it. And if you don't, it's going to cause you that same delay when you go on to buy the next property. Because what you'll find is some bridging lender or commercial lender has locked in a charge in your existing property already, even though you've fully repaid them. The charge isn't held on the property, it's held on the limited company and registered at company's house. So make sure you get rid of all those charges on the property and on company's house when you come to redeem. If you want to know any more about limited company and the lending around that and have any more advice and tips on it, then please get in touch with the team at Harvey Bowes. We're happy to help.